Now, inside of this range, there's going to be something they call gaps, fair value gaps. It's one-sided liquidity that is unmitigated. And what we want to see is we want to see price mitigate those gaps. Okay? So every time price creates a new low or there's a break of structure, price is going to want to trade into a gap that was formed on the creation of that new low. This is in a downtrending scenario. Alright? So what does that look like? Take this move for example, right? This is the low that was recently broken. Now there's gonna be gaps on this new range that formed, this range. So what we're going to do is we're going to look at that range and we're going to identify the gaps. Now maybe there's a gap here, right? Maybe this was a gap. This is where the gap was. The whole idea of ranges is that after price created this low, price is going to trade back into this gap and then continue lower. So do you see it? So now we know order flow is bearish because we could use market structure to see that lower lows are being made and the higher lows are not being touched. They're safe. We looked at the ranges. We saw that every impulse swing, every new low created a new price range. And that price range had arrays like gaps, bullish order blocks, bearish order blocks, breaker blocks, all those type of things where there's liquidity, money sitting. And then the last thing we want is liquidity. So this is very important. This is the key to this idea, because you don't want to enter the trade on this gap. You can, that's a setup. But in reality, the real continuation move happens when this happens. All right. So price traded into this gap right here and then fell. So this new high that formed here, you can put a dollar symbol on it because now there's liquidity sitting above that high in the form of what? Buy stops. All the people who sold here, they have their buy stops sitting above this high. So now the real move is price is going to want to rally back up, tap into this pool of money sitting here, then continue lower. And that's it. It's so simple. All you need to know is for a continuation trade, you always need price to tap into a gap, create that pool of liquidity right here above the gap, and then come back to run out that pool of liquidity. That's where you enter for your continuation trade. All right. So let me just quickly run through that one more time, and then I'm gonna show you guys on the chart. So it's very simple. I told you guys, you're gonna have trending markets, breakup structures, creating lower lows, and for you to enter a continuation play, what you want to see is price should come back, trade into a gap in the range that was recently created, show willingness to sell. Sometimes it may take out this low, sometimes it may not, but it needs to show a willingness to sell that will create liquidity above here, and then price needs to run out that pool of liquidity, and therefore it's always gap, then run of liquidity, continuation. There will be a break of structure, lower low, gaps, price trades into the gap, then price runs out that liquidity that was created from trading into the gap. And that's it. That's how I do it every time. And I'm showing you guys on the chart now. So this is the Dow Jones. And we'll look at when the Dow Jones was trending downwards. Alright. We're gonna look at this period in time when the Dow was trending downwards. Okay? And we're gonna look at it on the 4 hour. So this is what I'm talking about. Price was trending upwards prior, up until this point. You can see that price had been trending upwards, right? Higher highs, higher highs. So it was trending upwards before we got into this box. Now let's look at what happened. This was the most recent break of structure high that occurred. So we had a new high form when these highs here were taken out. When these highs were taken out. So what should have happened, John? How did you know that price was going to switch and start trending downwards? I told you guys, after this high was taken out here, price retrades into a gap. As you can see, price retraces into a gap, continues. So what happens now is this. There's money sitting under this gap, under this low. If price is still bullish, price should take out this low and then continue higher. That would have been a continuation trade for a market that was going to remain bullish. But no, we're switching bearish. So after we took out this high, what happens? After we took out this low, what happens? Price tries to muster the courage to continue trending back up. It does that here. It fails, and then we have a break of structure. So you see, it fails here to continue higher, and then we have a break of structure here when this low, this initial low, is taken out here. So now that initial low is taken out here, right? Actually, I'm gonna use this low. The reason I'm gonna use this low is because price found a base here, could have ran it out, instead protected this low, went and took out these highs. Shows us that what buyers were interested. So this low meant something to buyers, because this is the low where buyers agreed that they didn't want to send prices lower any longer. So there are stops sitting now below this low. Now what happens is what? Price comes out and takes it here. Price comes back and takes that low here. Immediately after taking that low, price trades into a gap. Price trades into a gap right here. Price trades into a gap right here, falls lower, then retraces upwards, takes out the highs, takes out these highs, and then continues lower. This is what I'm saying. Then it continues lower. So now we've made a new lower low, right? Made a new lower low right here. Broke that old low, made a new one right here. But do you notice that alright, so price takes out this low for a new break of structure, right? Let me just tag that external liquidity. and then forms a new low right here. So we took out this old low, formed a new low right here. Now, from breaking this low, this break of structure happened right here. Break of structure happened right here. Now, if you go to a 2-hour chart, because you won't see this properly on the 4-hour, but if you look at that same chart, if you examine the 2-hour chart, you see that price, after breaking this structure here, price tried to trade back into a gap before failing. So this actually held as a rejection block before failing. Creates a new low. What happens? Price came back here, swept that high before continuing lower. Now we have a new low here. We're gonna call that external liquidity again. And we're looking for a continuation trade short to sell the market. Well, now you have this high sitting up here. We don't expect that high to get taken. So look at the range. What do you notice in the range? What do you notice in the range? There are what? Gaps. From a mitigation breaker block here, there's gaps. So what do you see here? Price eventually trades into the gap. After breaking this old low, just like I had mentioned here, after breaking this old low here, what did price do? Price traded into the gap. What did price do here? After breaking this old low here, right here, price broke this low. When it was trading down, what does it do? Trades into the gap. Trades into which gap? These gaps right here. Trades into these gaps right here. After that, what does it do? It looks like it wants to sell off. Okay. From its weak attempt to sell off, what do you have? You have liquidity form up here. What does price do? Price first goes to run that liquidity, then sells. Do you notice? Price goes, runs out liquidity, then sells. That's how I do it. And let me show you guys my Discord, because I literally called that exact trade when it was happening live. So this is not a like post price action type of analysis. You feel me? I'm gonna show you guys. This was the setup. I told them then. This was the setup. After liquidity had been run out here at this high, I told them sell this area. Look at it. That's the trade. So this is the idea, and this is how I do it. Look, this is another example now. So now there's a break of structure here. Let's remove all this makeup. There's a break of structure here. We had this low that formed here, then price broke it when it reached here. Price broke that low, created a new low. As you can see, this low of this candle being 47,916 is lower than this low of this candle, which was 47,987. Then what happens? Price, after breaking that line, forming a new breaker structure, price immediately trades back into a gap. Y'all see the gap? Price immediately trades back into this gap, then falls. But that's the trick, okay? That's not the real continuation trade. The real continuation trade is after price has traded into the gap, price needs to run out the liquidity created. Where is the liquidity? Liquidity is sitting in the form of what? Buy stops, sitting above that high. Right here. Price comes back, runs out, liquidity sitting up there, and then what happens? Boom. Another leg down. Another freaking leg down. And you can keep doing this too. Okay. So here's another example. Now this low gets broken. This new lowest low right here, this low gets broken when price trades through it right here. After price traded it through it right here, it created a new break of structure. Okay, what do you notice? Are there gaps? Yes, there are gaps. Where are the gaps? The gaps are created in all of these spaces. Does price trade into the gap? Yep. Price trades into the gap right here. As you can see, this candle trades into that gap, and then there's a failure. Price collapses. But I told you, that's the trick. That's not the real continuation move. After price trades into the gap, what do you need? You need a run of liquidity. So price trading into that gap created what? It created liquidity here. Created liquidity here. Right here. So now you have break of structure, gaps created, price trades into the gap, falls. Now you need a run of that liquidity for a continuation trade. So what happens? When price comes back up here, see now, this candle, this big white candle, has taken this high. As price took that high, what happens? Does price continue going higher? No, it fails. And eventually, what happens? It leads to another swing down. So that's it, really. That's the strategy. That's the concept. I just gave you guys game. I use this to swing trade, hold trades within the week for days, and I also day trade off this principle. So when I want to day trade, I just look at using this idea of market structure of higher highs, higher lows, and continuation trades. If we're continuing, have we run out the liquidity yet? Are we just trading into the gap? So I'm just looking at the structure of the market and I'm asking myself, where are we right now? So depending on where we are right now, that's what matters for day trading, because that's what's going to determine where the session wants to go. But in terms of swing trading, this is the game right here. I just look at the chart, the structure. If we're trending up or down, where are we? If we trade into the gap, I'm gonna wait for that gap to get run out. When that liquidity is taken out, then I enter, I execute. And that's how to take continuation plays.